All right, we'll pick back up. This should be our last section of chapter 11. So I just want to start out by reminding you that standard deviation measures total risk. So, question: which has more total risk? That would be the security with the highest standard deviation. Which has the most systematic risk? Beta measures that. So this security C would have the highest systematic risk, the most exposure to systematic risk. So you remember that the market itself, the S&P 500, has a systematic risk of 1. Security C here has more exposure to these systematic factors: inflation, interest rates, GDP, things that impact every company in the country. Security C is more sensitive to that. So when interest rates go up, it is likely to go down more than the market. Security C is. So which would have the higher expected return? Well, I'll let you figure that one out. So now we have a concept called the risk premium. What is risk premium? Well, risk premium is the investor's compensation for bearing the risk of being in the stock market. Okay, and so we introduced this nomenclature here. RF is for risk-free. Okay, you know that risk-free is the return. It's getting kind of late here. The return for Treasury bills. So the return on Treasury bills is considered the risk-free rate because they're backed by the full faith and credit of the United States government, who is the most respected economy in the world and can print money at will. So they can always pay back the loans that was made to the federal government to buy these T-bills. So the risk premium is the expected return of the market minus the risk-free element. Okay, and we're going to develop this model a little bit more, but we get this compensation, this return for taking no risk, right? I'll put here no risk, and no risk is the risk-free piece. And this is the total return right here, the expected return of the market. So the greater the beta, the greater the risk premium should be. So we'll build on this a little bit. And this is one of the key things I would really encourage you to spend some time with and understand this graphic here. This is called the security market line. Here it is. Security market line is the graphical explanation of the capital asset pricing model that I've been talking about in earlier videos about this chapter. And this formula right here is the capital asset pricing model. Okay, that's it, and don't be afraid of it. We're going to learn it very well. And this security market line, this is the line right here, the security market line. But it kind of illustrates this capital asset pricing model. So what's it about? Well, look at the y-axis is beta. Okay, see here, this is beta down here. And the y is the expected return of an asset. So first of all, like I said in the last slide, this up to this area right here, this amount of return here, we get for taking no risk at all. Okay, this is the risk-free element, the T-bill return, and we've got a beta of 0 right here. Okay, so beta equals 0 right there. And when we get, this is the right here, we've got, this is the market. See if I can use a little cursive writing here. And not completely. Okay, so that is the market beta of 1. And where it intersects this SML line, SML line is the return of the market. Okay, so this to this level is the return of the market, made up of a risk-free component right here, and there it is over here, the risk-free component up to that part, and then we've got a component of this overall market return called the risk premium of the market. Okay, so the expected return of the market less the risk-free is the risk premium. See right here, expected return of the market minus the risk-free leaves the risk premium of the market. So we can insert right here, look at this part of this equation right here. The expected return of the market minus the risk-free is the risk premium of the market. Okay, so we'll go over this some more here. All right. So if you go back to that slide, you'll see that anywhere along that security market line, there is a relationship between return and expected beta. And beta is a representation of risk. Standard deviation represents total risk. Beta represents the risk, the systematic risk portion of total risk, okay? So the ratio would be the same at any point along that line, that security market line, okay? The ratio of risk to return. So remember that risk and return are traveling companions. When one's high, the other's high. In fact, they have the same risk-reward or reward-to-risk ratio. Okay, and that's what this formula, you don't have to really remember this formula, but just know that as risk goes up, so does return by an equal percentage. So that security market line, it represents all points of market equilibrium. Whenever at any point of beta, we can find what the expected return should be. That should be. And that would be considered equilibrium. And then there's times, look at this, that some securities might plot above the line. If they do, then they have more risk than they have, more return than they have risk. If they plot below that line, they don't have enough return to justify the risk. Okay? So, and one other thing to keep in mind is that opportunity cost of capital, when you hear that term, opportunity cost of capital, that's the return we could earn by investing in other assets with the same risk. So if we invested in a security that plotted below the security market line, we have an opportunity cost of capital because we could be investing in another security that plots on the line and has enough return to justify its risk. So we've built a little background there. Now you know that the risk-free rate is the RF is the risk-free rate or the T-bill. Market return, RM, that stands for the return of the market or the S&P 500. This RPM is the market risk premium, and this is it. When you see this equation right here, that is the market risk premium, and it is the expected market return minus the risk-free. Okay, so I want you to note when we look in this part, this is the capital asset pricing model in this box, and this component right here is the market risk premium. Okay, RM minus RF. That is the market, let's see here, risk premium of the market. Okay, interchangeable. If you see a problem that gives you the market risk premium, you do not have to solve this right here. You're given it. Okay, we take the market risk premium times the beta, and then we add back right here the risk-free component, and that gives us the expected return of a particular security. So, in fact, here on the second line right here, you see these are the same equations, just restated. There is your market risk premium, or risk premium in the market. And if you're given the expected return of the market return, then you've got to use this first equation up here. Either way, you multiply by the beta of a particular security. See that? The beta of I, of a security I. So we're going to practice that a little more. So, and this just kind of restates what I just told you. I tend to get ahead of myself. This is the expected return of common stocks less T-bill rate. That is the market risk premium. I just went over that. And this states it again. So you're seeing this over and over. That should tell you this is pretty important to not confuse market risk premium with the return of the market. The market risk premium and the return of the market, two different things. One more time. I'll point it out on this slide. This is the market risk premium. Here I'll use a different nomenclature. Market risk premium is right there. So if you are given market risk premium, do not plug it in. Don't plug it in here. It is this entire expression right here, okay? So just don't confuse that. So if we know beta, if beta is known, we can use the capital asset pricing model. And a fundamental tenet of this model is that a stock's returns are completely explained by beta plus unique risk. So you can practice solving this equation here if you like, here at the bottom, by plugging in the market return. This is the return of the market. So there it is right there. Minus the risk-free right there. Risk-free rate, the T-bill rate. Multiply it by the beta. So let's start off with the beta right there. And then you've got to add back the risk-free rate right here and work that equation. And unfortunately, I did not get 13.4. I got 13.35. I expect you will as well. I can't explain why they have 13.4 on this slide. But the point of this is that if you require a 13.4 or 13.35 return and the expected return on the stock is 14, then of course the return is higher than what you require. So that would be a good purchase for you. Now, here over to the right side, right in here, it says share price is too low. If prices go up, then the expected return will go down to the required return. So it's undervalued. So what that means is that if share price was higher than it currently is, then this 14% would be lower. So let's, for instance, if we have a stock that's priced that we think is going to go to $114, and it's trading at $100, we would have that 14% return. If the share price was lower, see right here, if it was lower, no, let's check that. Let's check that. So it says share price is low. So if share price was higher, instead of 100, if it was 104, then we wouldn't have a 10% return. We'd have closer to a 10% return, right? Because it'd go from the 104 to 114. So the point is, the higher the current prices are, if we have a set expectation for future price, the higher current prices are, the lower this expected return is going to be. So that's kind of a detail over here. I know that's a little confusing. The main thing is that that I want you to remember is you can calculate expected returns with using this. This is the capital asset pricing model right here that you just hopefully worked through, and you can calculate your required returns with it. Okay, so or your expected return. This E is for expected return. So just want to kind of make sure you get the detail here. This is a pretty good slide that shows you that what's going on here actually in the capital asset pricing model, the capital asset pricing model. And you're going to be using this even after the next exam in the following sections. But so the risk-free rate, again, is the T-bill rate. So I'll just make your T-bills, right? And since the T-bills have no risk, that's just pure time value of money, the return for not having your money for this period of time. So we get a return for that, for not having the use for our money. And then the risk premium of the market, which is this expression here we've talked about, that is the reward for bearing the systematic risk. That's exposure to changes in inflation, unemployment rate, GDP, interest rates, those sorts of things. And then the beta measures how much of that systematic risk. So these two things here are related, right? Beta is how much exposure, measures the sensitivity. Beta measures the sensitivity to systematic risk, and this measures systematic risk. Okay, so so that kind of breaks down what this capital asset pricing model is all about. All right, so we'll wrap it up right here.